Hi, everybody. Hoping you can see us. How you doing? Good to see you all. Hello.
Yeah, we are live.
Let's just check. Are we live? Yay! Hi, guys. I am, whoops. Let me mute that. Cool. Okay. So I'm coming to you live by myself. I usually have Nicola Grace here with me, my partner in Profit. And Nicola is really under the weather this past week, and I apologize. We actually canceled our last call because of that, which she was going to host. So the very wonderful Jeffrey is here helping me with tech, because normally Nicola does the tech, and I'm a newbie at it. So just forgive me if I make any mistakes, guys, because this is a tutorial channel here at Conscious Crypto Traders. We are all about the learning. We're all about wanting you to really understand the world of crypto trading, the mindset of crypto trading, and the strategies of crypto trading. So this is going to be all about the content today. So today, feel free to type your questions in the chat field. I'll be watching the chat so we can monitor your questions for you. And let's just rock and roll. So first things first, we're gonna start with the top 3 mistakes that you want to avoid when you're crypto trading. And this is super important because we really need the world of this and the mindset of this in order for you to start getting into that upper 20% of profitable traders, because 80% of traders lose money. We know that because the trading platforms, many of them actually posted their statistics. And you don't want to just be in the upper 20% that are making a little bit of money. You want to be in the upper 1% that are making a lot of money. So I'm going to start with sharing my screen. I've got a little slide deck for you over here. And whoops. Okay. Sorry, wrong order to my slides. So we're going to just work down the list. And this, I think, is the biggest one. And a lot of people fall into this trap, trading with too much leverage. And it's because a lot of YouTubers show these high leverage trades. They show you even 10x. They show their profit at 25x, at 50x. And they don't actually really explain how do you decide how much leverage you should be using and what's the risks associated with leverage. And the trading platforms themselves tend to suck you into trading with too much leverage because they report your profits based on the amount of margin you're using, not based on the size of the trade. And so they make high leverage trades look sexier than they really are. And let me explain that. I'm going to actually walk you through the math on this, okay? Because here's the myth. Here's the false assumptions that you really want to check. If you're believing that high leverage makes you more money, then that's actually a myth. High leverage does not make you more money. If you're also looking at the fact that the exchange reports higher profit when I increase the leverage, right? So we've all been on a trade and we switched it from 2x leverage to 10x leverage, and suddenly the exchange changed the profit from 10% to 100%, right? In fact, though, that's a myth, and I'll show you why, right? So I'm going to show you, and I've laid this out as 2 separate trades. I call this a tale of 2 trades, okay? So, and I'm going to use some assumptions just to make the math super easy so you can understand this, okay? So let's say we're trading Bitcoin and the price of Bitcoin is $50,000 US. That'd be a little bit higher than what we're trading at today, but easy to do the math, okay? And you're going to make 2 different trades. They're both $10,000 trades, okay? And the funding fees are 0.05% every 8 hours, okay? So that we're just talking funding fees on these trades. And you're keeping the same 2 trades open for 24 hours. So in other words, 2 identical trades. The only thing we're going to change on these trades is the amount of leverage you're using, okay? So here's your 40x leverage trade, and here's your 2x leverage trade. Okay, both a $50,000 trade. You basically, or the price of Bitcoin is 50,000 rather. You make a $10,000 trade. This one at 40x. So in this case, you're risking, if you risk 2.5% of your account, which is $250 in each case, right? In this case, your margin is $250, and you're in essence using the liquidation price as your stop loss, okay? So In other words, you can go 40x and the liquidation price is only $250 away, because with higher leverage, you've got much tighter liquidation. In this case, your margin is $5,000. In other words, you put in half the money and the trading platform put in the other half of the money, but you're using a 5% stop loss. So identical risk. In each case, you're risking $250. In this case, it's your entire margin. In this case, it's only a little bit of your margin because you've got a 5% stop loss, okay? Hoping you're with me so far, because it gets a little mind-bending. So let's say the price moves $5,000, okay? Assuming you're in a long position, that means the price goes from $50,000 to $55,000, okay? In both cases, your profit is exactly $1,000, because it's a $10,000 trade. The price moved, you now made, the price moved 10%, you now made $1,000. So you made the exact same amount of money on both trades. In this case, though, the exchange is going to report that as 400% profit, because it's reporting it relative to the amount of margin you risked, not relative to the size of the trade. This is the important distinction as to why the myth is created as to why high leverage makes you more money. Okay. In this case, the exchange is going to report it as only 20% profit, because it's reporting it relative to the margin that you risked. Where your stop loss is positioned has nothing to do with how the exchange reports it, but it has everything to do with how much actual risk you took. Okay. So same size trade, same risk, same amount of profit, but it's reported differently by the exchange. Isn't that interesting? And in this case, you paid almost $15 funding fees. In this case, you paid half the funding fees. Now that might not seem like much, because a $10,000 trade, not that big a trade if you're only risking $250. But it makes the point, in the two identical trades, the 2x leverage trade actually made you, if you take it relative to the $10,000 trade that you made and what you really risked, or rather the $250 that you really risked, right? This trade only made you 294%, and this trade made you 297%. Now, 3% might not seem like that much, but these numbers really add up over time, especially when you start making bigger trades. That can make the difference between 20 or 30% return on investment at the end of the year, cost averaged over all your trades. So this is a really important principle to remember. I actually did a whole video on this, how to determine what your leverage should be relative to your stop loss, relative to the amount of risk you're taking, right? And DaVinci J15 talks about this a lot too. We've got a lot of interviews with DaVinci J15 on this channel, where you want to choose an amount portfolio that you risk on any given trade. So let's, personally, I do 2.5% on any trade. And then you choose how big your trade is based on where you need to place your stop loss and how much leverage you're using. That's generally one of the best and most used risk management strategies for traders. And we've got a playlist on risk management that we can point you to at the end of this video if you want. Actually, Jeffrey, maybe you can put the link up to that playlist so they can go look at it. Okay. So that's mistake number one. Mistake number one is believing that if you increase your leverage, you're making more money. So when would you increase your leverage? Which is the obvious question that begs, right? And that's an important one to consider. Generally, traders only increase their leverage when they've been in a multi-day trade and now your stop loss is in profit and you want to add a lot to the trade, and now increasing your leverage is making the trade a lot bigger, okay? But generally, you're starting out at the lowest levels of leverage and then you're scaling up into the trade, not the other way around. Now, some traders like to just do a standard 10x or something like that right across the board, but that's normally normally not the case. Jeffrey, I'm actually looking at the channel and it's not showing us actually live on the channel. So I'm wondering if something's wrong. Can you check if we are live right now? Sorry, guys, I'm just going to pause for a moment and make sure this is working. Because when I look at YouTube, it still says waiting for conscious crypto traders. Can you hear me, Jeffrey?
Yes, I can hear you. Yeah, and
okay.
Actually we are live, yeah, on YouTube.
We are? Okay. Because just when I pull up YouTube, because I was going over to check the comments. Do we have any comments or questions then, Jeffrey?
Not yet.
Okay. Okay, perfect. So that's mistake number one. So let me go over back to my slides, and we're going to talk about mistake number two. And I call this mistake, and am I still sharing my screen? I'm not. Let me share my screen. Sorry, guys. Here we go. Mistake number two. Okay. Mistake number two is trading against what the indicators are telling you. Okay. And this is a really big one, right? Especially when FOMO or FUD are high. We see the market dumping and it gets to the bottom. So I want to look at this. Okay. So let's just pull up. And we are going to pull up this is most evident on the daily. So I'm going to pull up the daily chart and we're going to look at Bitcoin. Okay. Now this would be an example. Bitcoin's been trading in this big channel. The other thing we're seeing is we've got a clear downward trend on the RSI Bitcoin. And anytime a divergence like this in the RSI is happening in the highs, then we know that that's a bearish divergence, right? So we could say array of blue, green, yellow, red, right? And on this particular EMA, we recommend, and other YouTubers also recommend. I can't remember who the first guy that said this is. Sorry, I normally like to shout people out, and I just can't remember who it was that recommended this first. That you actually change the colors on the settings for this particular to blue, green, yellow, red, because it's easier to remember that as a color sequence. It's the color wheel. We've all been learning it all through school, right? So blue, green, yellow, red, bullish. Opposite, bearish. And what we've got right now is the blue line is crossed into the middle. So we could be in for a bearish cross here, which might mean we're about to break down, right? In that case, you know, and this really depends on whether you're trading from a position of certainty or a position of strength. If you're trading from a position of strength, you're trying to enter in at the bottom of the pattern here. I still sometimes do that, but I do much smaller trades. Like, so if the indicators aren't clear all in one direction, I might still open a position here just so I can add to it if the price is clearly breaking out or breaking upward, right? Because we've definitely broken out of the smaller pattern within the bigger pattern here, right? There was a downward trending channel here, right? And we've broken out of that. Whoops. And, you know, ideally we'd want to see that reconfirm this line of support and then move back upward. But, you know, we've got a clear break upward here. So you could be trading this. You can be trading the patterns within the bigger pattern. But in general, you want all the other indicators to agree with you. And in this case, there's a little bit of ambiguity in the trade, in the indicators. So you either significantly reduce the size of your trade or you don't trade. One of the best ways to make money as a trader is to have patience. Like, know when not to trade is one of the best things you can do as a trader, because entering into big trades when the market's uncertain is actually a good way to just decimate your portfolio, right? So if you've got a lot of contraindicators, just wait until the indicators are in agreement and then enter into a more solid trade. You'll end up losing way fewer trades, and in the long run, you'll be making a lot more money. Okay. Okay, let's go back to the slides. Number 3, and this in my world is the biggest one, because I used to be a Forex trader, came over to crypto, was kind of like switching from hockey to basketball. You might be an athlete, but it is a whole different sport. And the biggest reason for that is that we are in a deregulated market, and you must never, ever, ever lose sight of that. And what does that mean when we're in a deregulated market? That means that nobody is watching over the shoulders of the forces that own enough crypto that they can actually move the market and manipulate the market. If we were in Forex trading, if we were day trading stocks, if we were in the commodities market, there would be regulatory boards taking people to jail if they did market manipulation. And we actually, I mean, although there's no literal proof of this, there's all kinds of evidence to say that a lot of the big forces in this market are manipulating the market and moving the market in ways that, you know, wreck the smaller traders. Let me just say that. So one of the interesting things, and one of my Bibles is Bulkowski's Trading Patterns book, right? I don't actually have it here right now, right? Hold it up. Thomas Bulkowski's Chart Patterns. And one of the things he talks about in that book is that busted patterns actually usually perform better. Well, what's a busted pattern? We've seen hundreds of them in the Bitcoin market, right? All these patterns where it broke down and went beyond the line we were expecting it to go to, broke down, looked like it was going to be a downward break, came back around, went back into the pattern. And if you've been trading for a while, you've seen hundreds of these in the price of Bitcoin and any of these cryptocurrencies we're trading, right? Where it looked like it was going to break and run direction, did a U-turn, came back into the pattern, and then broke out in the opposite direction. Now, the really interesting thing about this is that usually when a pattern busts like this, when it fakes out in one direction, comes back around and moves in the other direction, it actually performs better in the other direction. And that's one of the things Bulkowski talks about in his book. And in the case of Bitcoin and other cryptocurrencies, I think we're seeing way more of those than in most other trading commodities because of the level of market manipulation that can happen in this industry, right? Everybody just gets so excited. Oh, it's breaking out. I got to put my trades in. And then just as soon as everybody got their trades in, market U-turns, everybody gets wrecked. So how would you trade differently if you were expecting that, right? Because if this being one of the biggest mistakes we can make, well, first of all, you're going to be paying way more attention to volume. In other words, if the breakout is not supported by the volume, then you probably are in a pattern that's about to bust, in a fake out. Be anticipating in it. Don't put in your trades. Wait till the market turns around. Or in fact, when the market comes back into the pattern, place the opposite trade. And in fact, I've started trading in a way where I am actually anticipating busted patterns and market turnarounds. And in having that mindset of that's actually a reasonably probable thing to happen here in this market, it's actually ended up making me a lot more money. Because there's two distinct philosophies when we trade, right? We can trade from a position of certainty, or we can trade from a position of strength. And the difference from those, and I mentioned this a few minutes ago, a position of strength would be to try and get every pip in a move. Like, so you would enter in at the bottom of a market structure, such as here, and you try and follow it all the way up, wait to see if it breaks out. If it breaks out, you continue in the trade. If it breaks down, you close the trade somewhere up here, right? That would be trading from a position of strength. Greater risk in trading in a position of strength, because if you're down here and we break down, then now you've lost your trade, right? A position of certainty would be you'd wait till it breaks beyond this upper support line, reconfirms the support line, trades above this original level, we see supporting volume, then we're super confident in the trade. And now you enter the trade from this position, and it's far less likely that you will then lose that trade, right? The only challenge with trading from a position of strength in this market is we've been seeing so many of these where it breaks out, comes back down, confirms, and then just at the point where everyone's putting their trades in, U-turn, busted pattern, back into the pattern. So lots of traders getting wrecked on trading from a position of certainty. So it's a good idea to develop some kind of risk management strategy around this, okay? One of the reasons I often put a small trade in, trading from a position of strength, is so that when I wait for the point of reconfirmation and breakout, I'm now dollar cost averaging down to a lower level, so that if the market U-turns, I'm not in a loss position, and I actually can close out the trade at least at a break even or a profit level. And when the market turns around, I'm still good, right? That's just a personal risk management strategy I use. But it's, you know, you can look at these factors and develop your own. I mean, lots of different ways to address this. But I think assuming that the market's not going to be manipulated and assuming that the market's not going to U-turn is going to be a really big problem for you. So there we have it. There's our 3 top mistakes. Any questions in the chat for us, Jeffrey? Or are we good?
Yeah, no questions so far.
No questions so far. Okay. So guys, thanks for joining us here on Conscious Crypto Traders. We are a tutorial channel. We deeply appreciate when you like the channel, subscribe, hit the notification bell, and click all. That's really helps support us. We also do live events, all donations to this channel, all proceeds from our events, if you buy us a coffee, all of that goes in support of our infrastructure projects here in our community in Costa Rica. We help pave roads and other infrastructure projects like that in our local community. So we do have an upcoming event, the Conscious Crypto event. We're bringing some of the top traders and top analysts and top experts on YouTube, people who are experts in offshore structures, in tax, in understanding the world of crypto. And we're bringing conversations that you can't have on YouTube into this event. I'm super excited about this event because these are the kind of mentors I want to learn from. So there's still time to get in at your early bird rate. Link for that is down below. And until next time, really think about it, guys. Trade consciously. We'll see you next time.